What's up, guys? Today we will review chapter 5 to 7. So these three chapters are very important when you're using Markowitz portfolio theory to calculate the expected return and the risk of a portfolio. So chapter 5, risk, return, and the historical record. Problem 7. Suppose your expectation regarding the stock price as follows. There are three scenarios: good, normal, and bad. So normally we assume the normal as the mean. So the expected return is the probability of each scenario times the holding period. Times the holding period return, which is the HPR, including dividends. So it's the probability of the good time times HPR, holding period return of the good time, plus the probability of normal time, HPR 14%, plus the recession time times the recession holding period return. So the expected return is 14%. The variance, because we assume that the normal time is the mean, so the mean return is 14%. And then we re-weight the variance with the probability of each scenario. So the variance is 35% times 44 minus 14, because 14 is the mean, and this is the variance. This is the expected variance of the good time. This is the expected variance of the normal time, because normal is the mean, so this is 0. And the last item is the expected variance of the bad time. After the calculation, we get the variance of the stock. The expected variance is 651. We take the square root. It should be there is a percentage. So if we take the square root, the standard deviation is 25%. So the key here is that normal growth is the mean growth if we assume it. Number 10, the continuously compounded annual return on a stock is normally distributed with the mean of 20% and the standard deviation of 30%. With 95% confidence interval, we should expect its annual return in any particular year to between which pair of values? Look at figure 5.4. So figure 5.4 is the classical bell curve of the normal distribution. So the 95% confidence interval lies in the -2 sigma to +2 sigma interval. So 1 sigma is a 1 standard deviation. Then with the probability of 95%, 2 sigma interval, the interval should be between minus 40% to 80%, because it's the expected return, the mean of 20% minus 2 sigma, 30% to 20% is the mean plus 2 sigma, 30%. So it's minus 40 to plus 80. CFA problem 2. Based on the scenarios below, what is the expected return for a portfolio with the following return profile? The same as the last question. There is a bad time, normal time, or the mean time, and the good time. So the expected return is the return times the probability of each time, and we sum it together. The expected return is 10%. Use the following scenario for stocks X and Y to answer 3 through 6. So this is good time, mean time, and this is the bad time, this is the normal time, and this is the good time. So for stock X, considering the 3 scenarios, the expected return should be 20%. And for stock Y, it's 10%. What are the standard deviation of returns on stocks X and Y? So if we assume the normal is the mean, then using the same calculation method, the variance of X should be the bad time. This is the return of the bad time. This is the mean return. So this is the expected variance of the bad time. This is the expected variance of the normal time, expected variance of the good time. So the expected variance should be 592%. If we take the square root, excuse me, this is not 592, this is 592% squared. So it's actually 1 over 10,000. This is also one over 10,000, and if we take the square root, we will get only 1% symbol. Using the same calculation, the expected variance of stock Y is 175. If we take the square root, it's 13%. Note that the key here is that normal market is the mean market. Assume that of your $10,000 portfolio, you invest $9,000 in stock X and $1,000 in stock Y. What is the expected return on your portfolio? So the expected return should be the percentage in each stock times the expected return of each stock. Because this is the definition of expected return. So the percentage is 90% in stock X. The expected return is 20%. So the expected return on X and the expected return on Y. So here, correlation or covariance between X and Y does not matter because diversification does not affect the expected return. So when does it matter? It matters for risk when we are calculating the variance. So if we translate the 19% in dollar amount, it's $1,900 in returns. Next, chapter 6, capital allocation to risky assets. So now we are going into portfolios. Number 1, which of the following choices best completes the following statement? An investor with a higher degree of risk aversion compared to one with a lower degree will prefer investment portfolios. If the investor averts the risk, he will not invest in higher risk premium portfolios or riskier portfolios, so A and B is not right. And C, with lower Sharpe ratios with higher Sharpe ratios. Sharpe ratio is the expected excess return over the standard deviation, but the risk aversion only talks about standard deviation, so the Sharpe ratio is not in the investor's consideration. So the correct choice should be E. None of the above is true. Number 3, what do you think would happen to the expected return on stocks if investors perceived higher volatility in equity market? Relate your answer to equation 6.7. So this is equation 6.7, or we call it the risky allocation, Y, or Y star. Y star is the risky allocation, or the proportion allocated to risky assets. So how do we get this? We solve the linear optimization, which is the above problem, using Lagrange multiplier. Excuse me. Lagrange multiplier. You don't need to solve this in exams, but maybe it's interesting to know how you solve this. So this is our maximization problems. This is the risk-free rate. This is the risky expected return. So this is the excess return. If we open the bracket, we can see that you invest 1 minus Y in risk-free assets and Y in risky assets. And this is the variance of the portfolio with only single risky asset and the risk-free asset. If we solve this problem, we'll get the optimal risky allocation is the excess return over the variance. And A is an undetermined coefficient. So that is, and assuming no change in risk tolerance, an unchanged risk aversion coefficient A, higher perceived, if there is higher perceived volatility, the denominator is increased, so the optimal risky allocation Y will drop. So if the volatility in the market increases, Y will decrease. This is very intuitive. If you expect higher risk in the market, what will you do? Assume you are a normal investor. You invest less on risky asset. Maybe the voucher fund will invest more aggressively because they tend to get hold of the control of the financially distressed companies. Number 10, calculate the expected return and variance of portfolios invested in T-bills and the S&P 500 index with weights as follows. So we have to calculate different portfolios. There are 1, 2, 3, 4, 5, 6 portfolios with Treasury bills and S&P 500 index. So we consider the S&P over the past 85 years expected return is 8% more than Treasury bill return, and the Treasury bill return is 5%. So for S&P 500, the expected return is 13%. And the Treasury bill standard deviation, Treasury bill doesn't have any standard deviation because it's a risk-free asset. The S&P 500 standard deviation has been about 20% per year. So we use the same calculation as the previous questions. This is the weight of Treasury bill, the return on Treasury bill, no standard deviation on Treasury bills. This is the weight of the index, the expected return of index. So expected return is the weight times the expected return of each asset. And the standard deviation only comes from the S&P 500 because Treasury bill is a risk-free asset. It doesn't have any standard deviation. So the variance of the portfolio is the square of the standard deviation. CFA problems 8. You manage an equity fund with an expected risk premium of 10% and standard deviation of 14%. The rate on Treasury bill is 6%, so the expected return on your equity fund is 16%. Your client chooses to invest $60,000 of her portfolio in your equity fund and $40,000 in a T-bill money market fund. What is the expected return and standard deviation of return on your client's portfolio? So the expected return for equity fund, 16%, and rate of return is the percentage times the expected return of each asset class. 60% investing a 16% equity fund and 40% invest in a 6% treasury bill. So the expected return is 12%. If we transfer it into dollar amount, it's $12,000 and implies the total wealth at the end of the period is $112,000. And standard deviation, only your equity fund has a standard deviation. Treasury bill has no standard deviation. So it's the percentage times the standard deviation of the equity fund, which is 8.4%. Now let's finally come to chapter 7, the essence of the Markowitz portfolio theory. Number 11, stocks offer an expected rate of return of 18% with a standard deviation of 22%. Gold offers an expected return of 10% with a standard deviation of 30%. In light of the apparent inferiority of gold with respect to both mean return and volatility, would anyone hold gold? If so, demonstrate graphically why one would do so. So apparently gold has lower expected return and higher standard deviation, which is higher risk. So if we choose between stock and gold, there is no doubt that I will choose stock over gold. But now we need a portfolio. And we know that during stagflation, gold performs really well. So in a portfolio sense, we should hold gold and stock together. So as long as two asset class, stock and gold correlation is less than 1, there is benefit of diversification. This is from the classical portfolio theory. And if the correlation of gold and stock, we assume it's -1, then it's a perfect hedge. So from the graph, we can see that to construct the efficient frontier, we need two assets whose correlation is less than 1, and stocks and gold are the two assets, and they construct the efficient frontier. And if we draw a tangency line between the risk-free rate and the efficient frontier, we'll get the tangency portfolio, or the optimal tangency portfolio, which is P. So even though it seems that gold is dominated by stocks, gold might still be an attractive asset to hold as part of a portfolio. If the correlation between gold and stock is sufficiently low, gold will be held as a component in a portfolio, specifically the optimal tendency portfolio. That is, to construct the efficient frontier, we need both stocks and the gold. Number 13, assume that the expected return and standard deviation for all securities, including the risk-free rate for borrowing and lending, are known. In this case, all investors will have the same optimal risky portfolio. This is certainly false. It just tells us the borrowing and lending rate are known, but we don't know how much the borrowing and lending rates. So at least for the borrowers and lenders, their optimal risky portfolio is not the same because their expected returns on their portfolio is not the same. Although for all securities, it's the same. And moreover, we know nothing about their risk appetites or risk tolerance. So risk tolerance and risk appetites will dictate the shape of their utility curves, which will determine the optimal risky portfolio. The main reason, it says that the expected return for all securities, including the risk-free rate, are known. Yeah, it's right. It's just known. It's not equal. So there are two reasons. One is that borrowers and lenders can have different portfolios, and the other is that they will have different risk tolerance. We don't know for sure. CFA problems 4. Which one of the following portfolios cannot lie on the efficient frontier as described by Markowitz? So this question is different from question 11 because now we are talking about the already constructed portfolios. So portfolio Y cannot be efficient because it's strictly dominated by X. Portfolio X has both higher expected return and lower standard deviation. So we're not talking about a single stock or a single bond. We're talking about portfolios. So now the correlation between different assets have been taken into consideration. If we see an already constructed portfolio is strictly dominated, we will choose other portfolios. Number 5, which statement about portfolio diversification is correct? A, proper diversification can reduce or eliminate systematic risk. It can never eliminate systematic risk. Diversification reduces the portfolio's expected return because it reduces the portfolio's total risk. This is false because diversification has nothing to do. Well, it's not nothing to do. Diversification does not necessarily reduce the expected return because if it reduces, why do you need diversification? C, as more securities are added to your portfolio, total risk typically would be expected to fall at a decreasing rate. Yes, this is why we need diversification. D, the risk-reducing benefits of diversification do not occur meaningfully until at least 30 securities are added in the portfolio. This is false. There is not a golden number named 30. Number 6, the measure of risk for a security held in a diversified portfolio Is A specific risk? No, because we are talking about security held in a diversified portfolio. B, standard deviation of returns? No, these are single risk or idiosyncratic risk. C, reinvestment risk? No, it has nothing to do with it. D, covariance. This is the right answer because we are talking about security in a diversified portfolio. 7. Portfolio theory as described by Markowitz is most concerned with A, the elimination of systematic risk. No, you will never eliminate systematic risk. B, the effect of diversification on portfolio risk. This is the right answer because the Markowitz is concerned with optimize the return given unit level of risk. C, the identification of unsystematic risk. No. Active portfolio management to enhance return. No. It's risk-adjusted return, not absolute return. So according to Markowitz, we need to optimize return given a unit level of risk. Number 13, Dudley Trudy, CFA, recently met with one of his clients. He typically invests in 30 equities drawn from several industries, but the client complains that since the CFA has best ideas on like 5 stocks, why invest in 30 stocks when you obviously have stronger opinions on only a few of them? So Trudy plans to respond to his client within the context of modern portfolio theory. We know that if the correlation is less than 1, there is benefit to add securities in your portfolio. A, contrast the concepts of a systematic risk and firm-specific risk and give an example of each type of risk. So systematic risk, like the 2009, 2008 financial crisis, or the business cycle of boom and bust, inflation, monetary policy, fiscal policy, tight, or I should say austerity, and expansionary, and technological changes. Those are the fluctuations those are macroeconomic factors that you cannot change. So you can do your best to avoid the impact or to lessen the impact, but you can never avoid it unless you close all your positions. While firm-specific risk refers to the idiosyncratic risks that are independent of the market, such as industry-specific, firm-specific, litigation, lawsuits, patents, management, operating cash flow, financial leverage, bankruptcy, etc. B, critique The client's suggestion discuss how both systematic and firm-specific risk change as number of securities in a portfolio is increased. So truly, you should explain to the client that picking only the top 5 best ideas would most likely result in the client holding a much more risky portfolio, because there is benefit of diversification. And the total risk of a portfolio is the combination of systematic risk and firm-specific risk. The firm-specific risk is idiosyncratic. So here, the key is the covariance. Covariance can be decomposed into 2 parts. One is the correlation of single stock to the market, we call it beta, and the other is the variance of each stock, which is the idiosyncratic risk. So how both systematic and firm-specific risk change as the number of securities in a portfolio is increased. So the systematic component depends on beta. If we add stocks, there is benefit of diversification. While the number of assets will not affect the systematic component of portfolio variance, the beta will change because it depends on the individual security betas and the portfolio weights of those securities. So there is indeed benefit to add, well, you should add correct stocks. Do not add those stocks which is even more volatile or higher correlation or perform worse than the stocks that are already in your portfolio. On the other hand, for the idiosyncratic risk or non-systematic risk, idiosyncratic risk or non-systematic risk, increasing the number of securities in a portfolio reduces firm-specific risk. For example, a patent expiration for one company would not affect the other securities in the portfolio. An increase in oil prices is likely to cause a drop in the price of an airline stock, but will likely result in an increase in the price of an energy stock. As the number of randomly selected securities increases, the total risk will also increase, approaches its systematic variance. So here, increasing the number of securities in a portfolio does not necessarily reduce firm-specific risk, but as a portfolio, adding stocks like the oil company and the airline company, oil and airline, is beneficial. So on the one hand, adding stocks affects the total beta. And on the other hand, there is benefits of diversification. So both systematic and firm-specific risk will change as the number of securities is increased. Actually, the firm-specific risk to a specific firm will not change that much. But as we talk about it, if we add oil and airline in the same portfolio, the portfolio will perform better. There is no change to a specific firm because the risk of a firm is a risk of a firm. So Excel exercise 7B2 and 7B6. 7B2 is to use Excel to calculate the expected return, and 7B6 is to calculate the standard deviation of a portfolio. This is the expected return of a portfolio. The calculation method is the same as in previous problems, so we will not cover it here. You can review this in Excel. That's pretty much chapter 5 to chapter 7. If you have any questions, feel free to write me email. Thank you. See you next time.